Dear students, welcome to Swayam SHIKSHAA. So we are starting our fifth theme, and we are very happy, and we have got a lot of good comments, and students are appreciating our work. And today's theme basically, we have named it as everything about bonds. This is a very important area because there are many questions related to this and UPSC, and many students have a confusion. And what are the current questions that can be asked in the exam? That is one more important area. Generally, students will find it little difficult to understand this concept. And along with the concept, there are also challenges for the student with respect to identifying questions from where UPSC can ask questions. So now let's try to see a few questions here, previous questions. So with reference to masala bonds, sometimes seen in news, it was in news that time. So masala bonds was asked twice. We'll see what it is and all. Which of the following statements given below are correct? So there was this question that was asked related to bonds. Then Indian government bond yields are influenced by. So when I say bond yield, what is the yield? What is the influence of bond yield? What is the relationship between bond price and bond yield? What is inverted bond yield, etc. So these things we'll try to understand today. And then, of course, this question we'll do it later. We'll do it in the investment part. Okay, then we have with reference to Indian economy, what are the advantages of inflation index bonds? This is also a previous question about inflation indexed bonds. So what are these bonds? We'll try to understand. And then convertible bonds. So there are convertible bonds, non-convertible bonds, etc. So first of all, what we'll try to understand here is, when I use the word bond, bonds are basically debt instruments. These are instruments to raise debt. These are instruments to raise debt. So one important aspect what we should understand is, there is always an inverse relationship between bond price and bond yield. When I use the word yield, it is nothing but the return on the bond. Yield is nothing but the return which we get on the bond. So simple way to understand here, we'll try to understand it through an example. Now, first of all, when I use the word bond, bond is something like a paper which has some details on it. For example, a particular company X is issuing this bond. This X can be government, this X can be a corporate company. It has the price of the bond is 100 rupees. And the interest they are going to pay, the coupon rate is 5 rupees. So this is called as the coupon. So when I use the word coupon, so there are some non-coupon bonds also. So non-coupon bonds are non-interest bearing bonds. So when there is a coupon rate mentioned, it is a coupon bond. So here in this case, the coupon is 5 rupees. Okay. And 3, there can be something like the validity of the bond. So these bonds may not be everlasting. So there is a maturity period till which this coupon rate will be paid, this 5 rupees. So let's say the maturity period of the bond is 2 years. Then after 2 years, the principal amount will also be returned back. The principal amount will also be returned back. So this company called X has issued these papers called bonds, and all others, investors, have purchased this. So this X is a debtor who is borrowing money from the market by issuing this paper called as bond. And therefore, these papers are called as debt instrument, because this paper has been used by X to raise debt, and therefore this paper is called as a debt instrument. Now what we'll try to understand here is, suppose there is a bond, 100 rupee, bond price is 100 rupees, and the coupon rate offered is 5 rupees. Coupon rate offered is 5 rupees, let's say every 6 months. And the bond is validity is for 1 year. Okay. So that means the yield on this bond is something like how much? 5 out of 100. It is 5%. 5%. So this is basically the yield. So a better way to understand is, let's say there is a bond which is 100 rupees and the coupon rate it is offering is 10 rupees. That means yield is nothing but, the bond yield is nothing but the coupon rate divided by, bond yield is nothing but the coupon rate, that is a 10 rupees, divided by the price of the bond, which is nothing but 10% in this case. Now in the market, you're trying to sell this bond in the market, and the economy is not doing well, and you don't have buyers. So you decided to sell this bond at 90 rupees. 90 rupees. So one thing should be clear. You can hold the bond till the maturity period, or you can sell the bond in the market. Now in this case, we have sold the bond in the market for 90. The coupon rate remains the same. The coupon rate is something like 10 rupees coupon. So the yield now is how much? The bond yield will be coupon rate divided by the price, bond price. Your bond price is 90. So it is basically 10 out of 90, somewhere around 11.1%. Okay, that means the understanding is when my bond price decreased from 100 to 90, bond yield increased from 10% to 11.1. This is what we should understand, very important. So bond price is inversely related. Bond price is inversely related to bond yield. Very important understanding. Okay, now if this is clear, the question comes up, if bond yields are continuously increasing, then the loans will start becoming costly. Loans will start. Why? Because now the yield has increased to 11.1. Now I want to raise money from the market. Now if I have to issue these bonds and raise money from the market. Now I have to offer them an interest above 11.2 or 11.1. That means as and when bond yields are increasing, means my borrowing or raising loan from the market is going to become difficult or costly. And because of that, people or companies may shift to equity market, to the share market to raise money rather than the debt market. So this is one understanding. Now several factors, UPSC was asking several questions like, what will happen, what is the impact of, let's say, inflation? Will inflation have any impact on bond yield? Now, simple way to understand is, when inflation is increasing and the value of money is coming down, okay. Now, somebody wants to issue new bonds and raise money from the market. Now, he has to, suppose, if inflation has increased from 5 to 8%, let's say. Now, there is a company which wants to issue bonds and raise money from the market. Now, this company which is issuing bonds has to offer higher coupon. Earlier, let's say coupon was only 10. Now, they have to offer a coupon of 11 or 12 because inflation has increased and the value of money is coming down. So, you have to offer more. You're offering more. Means, when the inflation is there, bond yields may increase. Bond yields may increase. Why? Because you have to offer higher coupon, higher return. So inflation has an impact on bond yields. Similarly, something that is done by a bank outside, for example, Federal Bank is doing something. Federal Bank has increased the interest rates or reduced the interest rates, whatever it is. Okay, so this will also have an impact on investments moving into India. Okay, this will have an impact on investments moving into India. Okay, so why? Because the investors, suppose interest rates in US is high, then the investors may move away from the Indian bond market to the US bond market. So here, unless and until you offer higher yield, higher coupon, higher rate, they will not stay. So that means interest rates will also have an impact on bond yields and bond prices. This is what we have to understand. Now, there is one important area which can be asked this time, which is called as inverted bond yield. Okay, so what is this inverted bond yield? And inverted bond yields have a direct correlation with recession. So in US Treasury bills, they find a strong correlation of the inverted bond yields. This they have found in 2008. That is the reason now also we can say, yes, there is recession in US, or there is a deep recession which is about to come. So when I use the word recession, If there is a negative growth rate for more than 2 quarters, the technical definition of recession, negative growth rate for more than 2 quarters, we call it as recession. So there is a direct correlation between inverted bond yield and recession that is about to come. So there can be a question on this. Okay, strong correlation. Now if I have to draw now I want to draw a graph related to bond price and bond yield. Suppose if I have to draw, I am taking something like the maturity periods. Here I am taking maturity period of the bond on x-axis, and I have taken return on the bond, which is the bond yield on the y-axis. Now a normal graph should be in this fashion. A normal graph should be like this. That is basically, this is a graph where the long-term bonds, as and when the maturity period is increasing, 1 year bond, 2 years, 3 years, 5, 7, 10, the yield return on the bond should also increase. Otherwise, why will somebody hold a long-term bond? So there should be a direct correlation between the maturity period. The long-term bond should give higher yields. This is a normal graph. Okay. Then we have something like a steep graph. Steep graph is something like this is steep. This is not normal. So steep is higher, sudden increase in bond yield. So this I put it as normal, and this is a steep where the bond yields are suddenly increasing. Bond yields are suddenly increasing for the long-term bonds. Now the question comes up, another one is, we call it as a flat. We can call it as flat curve. Now flat is something like goes this way. It's a flat. So this normal one becomes a flat one. Normal bond yield becomes a flat curve. It becomes a flat curve. So you can see this flat before there is inverted bond yield. So when I say inverted will be something like in this fashion. Inverted is something like a reverse fashion. Inverted. That means bond yield inversion. This indicates some bond yield inversion here. This is an inversion. So it is opposite of normal. Inversion is opposite. That means long-term bonds are giving less yield. Long-term bonds are giving less yield. This is what we should understand here. So here if you can see the graph, long-term bonds should give less yield. This is what is bond yield inversion. Okay. So this bond yield inversion will indicate something like a recession which is about to come. A recession which is about to come. Especially in US, there's a very strong correlation. Why? Whenever there is a recession in the short term, the investors may decide, why should I invest in short-term instruments? Let me think of long-term. Because in the near short term, there is more risk associated. When there is recession, that is economic fall, there is more risk associated. So why not I put my money into long-term? So what will happen if people are buying more of long-term bonds? They are buying more of long-term bonds. So they're putting their money into long-term bonds means demand for this long-term bonds, demand for long-term bonds. Long-term bonds means the maturity period is high. Okay, so demand for this long-term bond will increase. So when demand is increasing, automatically the prices of these long-term bonds is going to increase. So bond prices will increase. This is what we have to understand. When demand is increasing, because people are investing into long-term, short-term is risky. So demand of long-term bond is increasing, prices of long-term bonds is increasing. So if price of long-term bond is increasing, then automatically this is bond price. There's an inverse relationship between bond price and bond yield. So that means if bond prices of long-term bond is increasing, it means the bond yields should decrease. That is what we have understood, inverse relationship. So bond yield should decrease. So this is the inversion. Long-term bonds, as the maturity period is more, long-term bonds have lesser bond yield. This is the y-axis. lesser bond yield. This is what we see, lesser bond yield, lesser bond yield. Okay, so that is the reason this inversion, bond yield inversion, the reverse to the normal, is an indicator that the recession is about to come. This is a very important area which we should understand. Okay, so very important area. This time there can be a question on this. Okay, now let's try to see few questions here. When they use a word convertible bond, so bonds are of different types. So convertible bonds are those bonds which can be converted into equity over a period of time. Okay, non-convertible bonds cannot be converted into equity. So there was one simple question, convertible bonds, as there is an option to exchange the bond for equity, convertible bonds pay a lower rate of interest. Yes, since there is an option to convert to equity, though they pay less interest, less coupon, people will buy. Yes, so statement is okay. Option to convert to equity affords the bond holder a degree of indexation to rising consumer prices. If there is inflationary effect, and if you are getting the same 10 rupees, that means, in fact, the real return is coming down. So you have an option to convert it into equity. So it is acting like an hedging. It is hedging the risk of inflation. So both the statements are okay in this case. Okay, so like this, there are simple questions if once we understand the logic of bonds. Okay, now with reference to Indian economy, what are the advantages of inflation index bond? This question they will not ask now. It was in 2011, 12, 13 where inflation was creating problems. So the word itself, inflation indexed, means these bonds are linked to inflation. When you're linking it to inflation, that is the principal amount is linked to inflation and even the interest is linked to inflation. So as and when inflation is increasing, the interest payment will also increase because you're changing the principal here, you change the interest also. You'll adjust the principal, adjust the interest with the inflation. So otherwise you'll not get the same 10 rupees here when the inflation is increasing. So they've linked it, that point of time they've linked it to our WPI, wholesale price index. They were giving something like WPI plus 1.5. So if WPI index is increasing, you get more interest. Okay, plus 1.5. That means this inflation has a negative impact. Why? Because inflation can create problem with respect to your return because the value of money is coming down. Okay, so this is, government can reduce the coupon rates on its borrowings by way of IIBs. Yes, inflation index bonds, the coupon rates can be adjusted by the government because you can adjust the principal amount. So principal amount you are adjusted means coupon rate can be increased or decreased. So yes, it can be done. IIBs provide coupon rate. So we have discussed what is coupon. Okay, so when I say bond yield, current bond yield is nothing but the coupon divided by the price of the bond. That is what you should understand. IIBs provide protection to the investor from uncertainty regarding inflation. Yes, because you are hedging it to inflation. So therefore, it protects us from inflation. The interest received as well as capital gains are non-taxable. No, that's wrong because why should they not tax is the question. When something is a bond, why should they not tax? So 1 and 2. So it's a simple question that was asked earlier. Okay, this question we'll do it later when I'm discussing FDI. Now see here, Indian government bond yields are influenced by, this was the question. So already this is recently asked. So the link of bond yield on the federal bank is taking some decision, it will have an impact on Indian bond market as we have discussed. And actions of the RBI, because RBI can inject liquidity or RBI can remove liquidity from the market. So money supply logic also plays a role here. Interest rates of the banking system get affected, which have an impact on the bond yields, etc. So the second statement is also okay. Inflation and short-term interest rates, definitely yes, we have understood the concept already. Inflation also has an impact on bond yields. And inverted bond yield will indicate that there is a recession which is about to come. Okay, so this was an earlier question which was asked, which is called as the masala bond. So that was the time when masala bonds were in news and therefore they've asked masala bonds. So masala bond is one such bond which are rupee denominated bonds. Rupee denominated bonds issued in other countries. So what is the benefit we'll try to understand. So when I say rupee denominated bonds issued in other countries, okay, so it's a rupee denominated bond issued in other countries. What is the benefit? What is the benefit? Now there is a risk, currency risk. When if the bonds are issued in dollars, let's say in US, a company let's say a company X is issuing, let's say a company X is issuing let's say a company X is issuing some bonds in US, okay, and it is raising money from the market. Now if it is issued in dollars, now $1 is 70, 75. This is basically the currency risk involved. There is currency risk always that is involved. Okay, so when you're paying interest, you're paying in dollars. Suppose when you're paying the principal also, it is dollars. You're collecting in dollars. So tomorrow, where you have issued bonds when $1 is 70, but you're making interest payments when $1 is 80, and you are paying the principal amount back again when $1 is 100, let's say. That means there is a currency risk involved for the debtor or the company X, which is issuing bonds. But masala bonds will remove this currency related risk because this risk is shifted from the company to the investor who is investing. Why? You're not issuing the bonds in dollars anymore. You will be issuing these bonds in rupees. So, rupee denominated bonds issued in other countries. So, X is issuing these bonds, and the investor, if he has to buy these bonds, he has to pay rupees to buy this bond. That becomes important. He's issuing rupees, is spending rupees to buy. Interest payments are in rupees. Principal amount also is in rupees. So that currency risk is removed for this company X, but the currency risk is transferred on the investor. That is what we should understand. That is what is masala bond. Rupee denominated bonds issued in other countries, and IFC was the first entity to issue such bonds. Okay, so there was this question that was asked with reference to IFC masala bond, sometimes seen in news, which was in IFC, which offers these bonds, is an arm of World Bank. It's true, IFC is an entity. World Bank Group has 5 entities, and in that 5 entities, World Bank Group has 5. In that, IFC is one. They are the rupee denominated bonds and are a source of debt financing for the public and private sector. True, both the statements are fine. So this is what we should understand, and I hope my effort has made things clear, concepts clear, especially with respect to bonds. Students have requested for economic survey. I'll come up with that economic survey. I'll compile it in a very comprehensive manner for prelims, and along with that, we'll also do some areas related to budget. So please keep watching. Please push your comments, because your comments are very, very important for our motivation. And please do subscribe and share our videos to all serious aspirants. Wish you all the best. Thank you. Signing off.